Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, November 7th, 2024. It's 10:40 a.m. Eastern Time since starting the video. I'm going to start out with once in a blue moon, I'll share a quick, day trading, intraday trade idea. I'll start out there, and that's a fade of QQQ. Reason being, simplify, I call it twofold. A fade because we have the Fed coming up today. Remember, they normally make their rate announcements when they meet on a Wednesday at 2 p.m. and they're doing it today at Thursday at 2 p.m. because of the election. And from my experience, when you have a big move down or a big move up, again, if you can make additional cases to go long or short, that's usually the trade to make. So now it's again if you day trade. Day trading, by definition, you take larger position sizes because you're going for smaller moves, and you don't have overnight risk. And in this case, the overnight is really, I want to say 2 p.m. I don't expect fireworks at 2 p.m. Although, see what happens. They're gonna cut a quarter point. That's baked in the cake. 90, almost 100% certainty of that. But they do release the minutes right away. At least a brief summary of what they discussed, a little statement, if you will, and that can influence the markets. But usually you see the bigger moves too when Powell comes on, does his press conference starting at 2:30. So bottom line is, after the FOMC, if you haven't done this before and you're watching intraday charts, this is a 5-minute chart, but if you're watching a 1-minute chart, you see a quick candle down, a quick up, and just be aware that the initial reaction is sometimes a lasting reaction, but almost never do you get an initial reaction that just keeps going in that direction. In other words, it's usually a swoon up, a swoon down, sometimes another swoon, and then and it's just it's a combination, mostly algorithmic trading programs and high frequency trading and things like that. And so, bottom line is, you usually want to be out before the rate announcement and or Powell's meeting afterwards. So we'll see where we go. But as far as a case for it, is that fade the mean reversion trade. Just since the election, we've had a pretty hefty rally, about over 5% in QQQ. Technically induced. This is my 5-minute chart. I'm just going to show you, what I'm looking at here. So I just shorted NQ, and you have two. I have two price targets. I'm leaning towards this one, and what I'll do is I'll get down here, I'll lower stops, I'll let it run down there, and that'd be about a 1% pullback. And actually, there's the gap right there. I'm gonna put another line right there. I think you can see it. There's a yellow line right there, and that's yesterday's close. So technically that's the gap, but often when I draw gaps, I'll look at a peak right before it like that. So that would be it. If we get a dump right there before the Fed meeting today, looking about a 1% drop. And I don't have to tell you, if you trade futures, just even with a single contract will give you, if you 1% move, and obviously multiple contracts, it's well worth it. So the case, of course, you can see on the 5-minute chart, divergence. I always say divergence isn't a sell signal. I like it much better when you have a clean up trend line, but we do have NQ at the futures at or very close to resistance right now. I'm going to cover that in 1 second here on a longer term chart. But when you look at the 5-minute chart, you can see it's simple, kind of semi-simple stuff. Wash, rinse, repeat. Look for these 5-minute divergent highs and 5-minute divergent lows. And you don't always have divergence when you turn, but quite often you're going to turn. And what I like to see, you can see down below, I have these lines, and that's really, I'll round it off. Everybody loves round numbers. You have it at 85 and 20. 85. Most charting platforms will give you the default overbought and oversold levels, which are 70 for overbought on the RSI and 30, the blue line here, which are oversold. Now, I take those and throw them out the window. They're useless on many securities. Again, it's just something, whoever, in this case Wilder, whoever that was, invented this RSI. Way back when, came up with those numbers, and they do work for a lot of securities. But then things like QQQ and volatile instruments that have big swings, it hits that level and it keeps going. There are some reversals there, but so on every security, whether it's a daily time frame, a 60-minute, weekly, or this 5-minute chart, I put my own lines. I just take a look at and see where are the extremes. Where does that security, the RSI, usually peak? And so you can see it's at 85, and typically, it's not a hard number, but typically around 20 on the downside when you're oversold, right? Okay, so that's simple. However, thing is that where the trend stopped? No, in fact, and this is why I'm big on divergence. It's typically the initial tag of that extreme overbought level followed by a lower tag on the RSI, and that is what we call, my friends, negative or positive divergence. So you can see there, you hit it, the purple line came in, made a lower low with prices making a higher high, and that's your negative divergence, and that did the trick. Down here, you hit the extreme negative 20 level, that is. Oh, no, I'm sorry, it's 20 level. And then you had a higher peak that was down right around the typical 30 level, and that was our divergent low. Divergent high right there, and then you did have a little trend line break, a sell signal with a secondary break there, and then that was a much bigger divergent high right there, and then you got this drop, which culminated with this divergent low. You can see again hitting these extremes. So that's the takeaway. So you already had the hit of the extreme yesterday on the post Trump rally, and then today you have a lower high on both indicators. So you have negative divergence, and again, negative divergence is not a sell signal. This would be better setup if it did have an uptrend line, so I'm not going crazy on it. But let me show you the futures, NASDAQ 100 futures. All right, so this is my the futures contract, which I clarified when I first laid this out in early July. It was literally, I think, a day before the NASDAQ peak. I gave you a preferred top of 2100-ish, and we hit exactly that. It was like literally 20,999, whatever. It was right within basis points of that 2100 level. And then we peaked there, we went down, and that's when we covered the morning of August 5th at T6 at the lows. So milked that, all that, sheared the meat off that bone for sure. And now we're back there. So although you have, the QQQ is also pushing and testing the previous high. So this is much, let me repeat, much more significant resistance than anything you're going to see on the 5-minute chart. So now there's a little room, a little upside, could go up another 0.5% or so. But again, but pretty good odds before 2 p.m. today, you're going to see some profit taking on this recent leg up. Again, based on fact, run into resistance and that 5-minute chart. And then now that could be the start of something much more. This segues into the question I had here. Let me answer that for you. Okay, so somebody asked, do you have a limit or maintains a market top range if we abandon the strong short thesis where it becomes probabilistic, not reasonable to hold or scale in from a swing perspective? Great question. Here's my reply. It's a possibility this week, but most likely next week should provide some color on whether or not the market will top around this level. Fed rate cut on deck today with Treasury yields at key resistance, meaning bonds are at support. Covered that quite a bit lately. So waiting to see how the bond market reacts to what the Fed says later today. I think that's going to hold the key here, guys. The odds are we reverse. The RR is very attractive for bonds right now, going long with stops somewhat below relative to where you think they're going to go, because I'm looking for a trend change. However, I'm not sold on it, and at some point, I think we're going to get that kind of wake-up call where bonds break, and yields punch through a resistance level that they should, quote-unquote, with my little air fingers, should pull back from, and then that's going to tell you the Fed's lost control. Is it going to come down? You can flip a coin. I don't know, but I'm going to wait and see. I'm not going to bet anything hard, as I've been saying for the last week or so. No need to go heavy into this week with both the presidential election and the Fed. I talked about that. So, and I went on to say, look, we've had plenty of long trade ideas to indirectly hedge or offset any shorts on the QQQ. So if you are short the Qs or plan to, I would kind of, at this point, wait and see what happens after the Fed. See how, and not at 2 o'clock or 2:01, not 2:30 or right when Powell wraps up. You're going to have that post-FOMC noise, I call it. Takes a day or two for the markets to digest what really was said and the impact of what we might see. So we'll probably not have a good idea until next week. On top of that, the levels when I first shared them back on the top market top levels, particularly for QQQ, it was back in November. I'm sorry, what am I talking about? It was back in June, late June, and it was based on a weekly chart. So all that matters is really how those weekly charts close. This week's candle closes at 4 p.m. tomorrow, and then next week's candle, which I'd really like to see, because I don't think we're going to have a lot of color, or clarity, if you will, this week. When I look at the market top ranges, here we go. This was it, unchanged since then, 511.74. You can call that 512 rounded up. We're right there right now. So here's the thing. Let's just say, and things will change between now and tomorrow, 4 p.m. most likely. But if we close there, well, that's still right there at the market top range. Excuse me, there, still at the market top range. And so, yeah, does that provide an objective short entry? Absolutely. You can take a short, and it's all about RR. It's all about your outlook, if you believe that. And RR would be the risk-reward ratio. Your stop would be dependent. I would not, let me just say this. That is still my target right there, my current final target. And that is still a drop of, as it was back then in June, roughly, 45 to 50%, right? You could say, okay, well, I'll use a 2-to-1 RR would be 25% stop loss. A 3-to-1 would be, less than that, somewhere, 18% or whatever it is. I wouldn't give it that much. I would give it, a lot less than that, and you still have a very attractive RR. So, in other words, you can allow a little punch through here, but ideally, again, it just lines up, and it doesn't have to be so to the penny. But ideally, you want to see a weekly close. You do not want to see a weekly close above there. As I've said before, it's not going to change. What really changes the picture will kind of skew some things and play around with my Fibonacci levels. Remember, one of the things I liked is how these price targets lined up. But, I can take that line up. Let's just take this fib line up right here. Actually, let's do that right now because that's where we are. About the 511, we're right at the top of the zone. Now, do you see what just happened? If you don't, I'll show you. We snapped even tighter to my targets. Remember, if you're new to the site, I'll reiterate what I said back then. When I made these, the market top range, first of all, we weren't even up there yet. So I was still calling for more upside from where we were. And that was based on various things, a lot of factors, including but not limited to Fibonacci price projections, which will tell you, where something might go to the upside. And that's really other than intuition, experience, read of the charts, gut feel, it's the only, well, there's others, but one of the better measures to kind of tell you where a security is going to go when there is no overhead resistance. Remember, when I draw support and resistance levels, it's easy to draw resistance levels when you have overhead reactions, candlesticks. But when you're at new or all-time highs or even multi-year highs, sometimes you don't have any resistance, so that's where you have to use those. But on the downside, it's easy on an uptrend to draw support levels because you have all those reactions. So where I'm going with that is, this was, and I told you how I made these, I first put the price targets where I saw significant price resistance, support, where a reaction would be likely upon the initial tag. And I gave you those targets, T1, which was already hit, T2, T3, and you can see, and I put a lot of I've talked about the Fibonacci retracement levels before. I incorporate them into my trading. They're part of. Some people trade almost exclusively off fibs. I just incorporate them. And what I've said, it never fails to amaze me when I always mark up my price targets and support and resistance levels first based on support and resistance due to prices, trend lines, things like that. Then I add in the fibs, and in this case, like I said, I did back then, look how the 23.6 lined up perfectly, especially now that we've eked out, made a slightly higher high. And so what I just did, I pulled my fib line up from that previous high just now in the video. That's what I was doing earlier. And then the fib snapped even like dead on, like that's perfect. 413 is T3. We haven't hit it yet. That's 38.2% retracement. So, effectively, for all intents and purposes, we're back to where we started. Again, so marginally slightly higher, it's almost immeasurable, but it is significant because it just simply extends the previous divergence. It doesn't come close to negating it. Negating it means you take out the previous highs. If the MACD moves up, the PPO moves up and it takes out that previous high, and the PPO or the RSI takes out those previous highs, then you no longer have the divergence. So that's it, guys. I just wanted to say that you can see how well these fibs line up, and who knows, maybe T6 is sitting a little above that 78.6 fib, but these main targets, T3, 4, 5, the ones that already been hit. Remember, we checked T2 and T3. Those have been checked. We covered when T2 was hit, reversed. Covered the morning of, we let it shoot through, and then covered that morning at the lows, just slightly under it, as we're, kind of booked profits on the shorts and then said, let's go long for a while. Now, this next leg down, they line up so well with those targets. And T7 is going to be basically 100% retracement, a full pullback and a wipeout of all that whole rally off the October 2022 lows. So, all right, that's it. So back to, kind of short-term stuff. Yeah, we're at resistance on the long term right here. And then short term, we're likely to get a fade before the close today to the tune of about, at least half and probably more like 1% from profit taking and technicals based on what I showed you on the 5-minute. And for you SPY traders, here's SPY S&P 500 just coming off that divergent low on the 5-minute chart right before the election results. Post-election rally, and there's that same gap. Again, minimum target would be the top of the gap right there. Here, if you're a SPY trader, I'll give it to you. And then likely there's the bottom again is all the way down here at yesterday's close, technically speaking. But sometimes, quite often, you'll see traders come in and cover right before that reaction high. And so let me give you a range. So at minimum from where we're at now to the top of the gap is about one third of a percent drop, 0.5% drop to the reaction high there, and a full gap backfill is going to be about a 0.6%. And that jives with, remember QQQ is higher beta. You're typically going to get more bang for your buck. It's going to move up or down more than SPY. Okay, another question was put to me yesterday. I said let's let the dust settle and I'll give you my thoughts on the regional banks, KRE. So they did, I had a resistance zone here. I had highlighted. We had several pullback short trades off there. And then, Trump won the election. And so the markets rallied because he's bigger into less regulation. And so banks rallied based on that. It ran a smack into, and this is a level I've had here for a long time. I've had this line here since 2021, back in June 2021. All the way back here is when I created it. And I did that because back then we were looking at divergent high. We were looking at a short on them, and that was support, and we broke it, and we went on to have a nice correction there. And since then, we've danced on it quite a bit. We had a major reaction low there, took the line out, rejected there, tried to recover it, but couldn't hold it, rejected. It's big resistance. So all I can tell you is that the regional banks have even bigger divergence than they had. Remember, they had divergence here. We had a nice correction. The divergence has not only not been negated, meaning we didn't take out the previous highs, it's actually even larger now. So then I always say divergence isn't a sell signal. So I can tell you they're at resistance, and I'm just watching them now. I'm watching everything really before doing much more, especially on the short side. You guys have seen more individual stock and ETF long trades lately. Intel, we've hit twice on that. Let me even cover that almost, but I haven't gotten any feedback. I don't know if anybody took any of these trades. Bought Intel long here. We ran it up for 30%, made literally a perfect exit. That was the final target, sidestep. Bought it back here. That trade was based on the 60-minute chart. We went up and had another double-digit trade. What was it, 10, 11% closeout yesterday. It was hit in after hours, and that's when I said get out. And we went all the way back down. When we recycled back down, back to that T1, which is support, I almost threw it back as another trade idea. I still think it has the potential to get, oh my God, especially if the market holds up. Yes, that potential T3. I gave you that all the way back. Actually, I gave it to you again this time around on this last trade. So again, the last trade was buying it back. This was a major basing pattern here. We broke out some numerous back tests, and now we've taken out that same. This is where we hit it on the previous trade, 30% profit. This is where we hit it again, and now we're above there, and we're backfilling this gap right now. So Intel, unless the market craps out, which is certainly a possibility, and even then, just remember that Intel has been for a long time marching to its own drumbeat. It has had almost an inverse correlation with both the stock market and the semiconductor stocks. In the case for the previous long, on the weekly chart, this was excellent support. I told you we had positive divergence at really good long-term support. And so, I even mentioned that it's kind of a longer-term trade, and we're already up 38% on it. It is. If it's a trade, we've been in and out. But that's the point. And there's a term I made up. I make a lot of terms up called velocity. Velocity is a term I made up years ago saying that, this is what swing trading is all about. You get in, you make 30%, you get out, you buy it back in if it gives you an objective, or you short it. I said you could have shorted that pullback. And then you make another, what was that, 10, 11%, I forget what it was yesterday. There's 40% on one stock in just a couple months, right? And you do that over and over, and that's what swing trading is, and it's blowing away, over the same time period since, let's say, the first entry there. So 40%, that was back on August 7th. And let's see what QQQ has done since August 7th. August 7th right here, QQQ is up 13%. Okay, so it kind of pales, and that's the thing about mixing it up, diversifying, going long, short, stocks in different sectors. And even then, like, I said, I'm just seeing if there's a line there, engaging one sector like the semis on, say, the short side, but then going long. I mean, we've had, and now, Intel we just closed out. Now we're long SMCI, and that's after shorting the damn thing down from the highs to the lows. That's mixing it up, and there's my longer term outlook is still bearish on the semis. Stocks, let's do an update there. Don't know if we're going to get that head and shoulders pattern, because the ideal thing I said would be to see increase volume down below the off the right shoulder here. This is the potential right shoulder, and so far we're not seeing that. We had this little kickback recently, but like I said, that to me, the bigger, much bigger thing is this uptrend line here. We just hit it the other day. We bounced, as I mentioned. I think I even said in the video, the only thing you do 3 days ago is to go long. You don't short the semis at major primary uptrend line support. You either wait for a break if you're bearish and then short, or you go long with a stop below. So the semis are still kind of grinding around, going nowhere for a while. Peaked back here, and this would be bullish if they take out 242, and this would be bearish if they take out the uptrend line. So I think we'll have some visibility by next week. Let's see how the market reacts to the Fed. To me, I cannot overestimate the importance of watching the bond market and treasury bonds. I'm going to put a little trend line right here. I just noticed on the semis. Oh yeah, there you go. Now you got a symmetrical triangle pattern right there, bounded by the primary uptrend line and this downtrend line, which now has enough reactions to validate it. So that's that. What else can I tell you? Nobody's asked, nor have I covered the small caps in a while. I just got away from trading them. But there is no, well, I shouldn't say that. It's not a sector. It's an index. But the small caps, as most of you probably know, are the most sensitive to interest rates because they're highly dependent on financing. And so, again, I cannot over-impress the importance of watching those key resistance levels we're testing right now in treasury yields. If the Fed loses control and if long-term rates break out and continue to run up and foil the current setups, we've got positive divergence still on the 60-minute chart, so treasury bonds at support. Bonds can rally bringing rates down. But if they don't, it goes the other way. Fewer indices will feel the pain more than the small caps. They are still below their highs back from 2022. They're getting close, but you have the same setup. See this? It was negative divergence. That played out for that drop down here. That was basically that third target I gave you with a fourth and final target of this uptrend line. We hit there. We also rallied. Look, everything rallied right here off this low. Now we have divergence. Divergence, of course, is not a sell signal, but it is a condition. It's a condition that often precedes trend changes. Negative divergence usually comes at the end of an uptrend and beginning of a downtrend, right? Just like you did here, just like you did here in COVID, just like you did before COVID back in late 2018, just like you did there in 2015. Those are all double-digit drops, over 20%. And that's what is likely, unless rates go the other way, and it's possible. But we'll watch. So I don't see a trade right now to be made. This isn't a strong uptrend, no sell signals. Something to watch, and I will keep an eye on those. The small caps, that is. Let's update GDX. Told you yesterday we're likely to bounce. A favor to bounce. It broke down. Pretty impulsive move. Hit that first target right there at 38.19. Said probably get a reaction. Said we could go all the way up there, although I wouldn't bank on it. And so we're over halfway there right now. Big resistance coming up. So if you either covered a short or went long to game the bounce, good time to at least raise stops to protect, at least guarantee a break even, if not a small profit, and or look to short if we get all the way back up there or even close to it. Again, you could get up there. You could take the whole thing back. That's possible. We just took back a trend line on QQQ the other day, so sometimes you have false breakouts. But again, big divergence says we're probably going to, at some point, this will run its course and we'll go down to that next target there, about $36. Oh, and as we wrap the video up, for you NQ traders, you futures traders, and for those of you, if you're new to futures and you want to cut your teeth, and NQ is a little bit bigger than your comfort level, what I'm talking about, if you know futures, they're leveraged, they're highly leveraged. They have the minis, the MNQ, and you can do MES, I think. But MNQ are the mini or micro. So it's just a junior size futures contract, just has a smaller multiplier, meaning less leverage factor, but it trades off the same price levels. So you can use my charts that I give you on NQ. And this is the target zone down here. It's 29.60 down to about 29.12. And that would also constitute you might get a hiccup here at this potential trend line. It's not super valid, but that's still calling for about a 1% pullback here. If that pullback target zone there is hit. Okay, let's just wrap it up here. We'll see how things go. That's the 5-minute divergence on the 5-minute chart there, which also gives the potential for more downside. Oh, I should sometimes I forget to do. If there's always a potential for a runner trade, especially for those of you your gunslingers that might want to hold into the Fed and hold out for more. That'd be the next stop there. I'd have to mark the chart up a little further. I'd have to go back in time a little further than this, go to a 15-minute chart. But, that'd be first target zone, second. And, anything more than that, you're going to have faded the Trump rally, Trump pump, whatever you want to call it. And that's going to be just dang bearish. So, if it happens, be on the lookout. Anything can happen this week. We can break out to the upside. But if we go down and we wipe out the rally over the last couple of days, especially in a one fell swoop, to put in, let's say, for example, a bearish engulfing candlestick on the daily chart of QQQ or NQ, and especially at the top of my market top range, that's like get out of Dodge bearish type stuff. But it hasn't happened yet. I just want to point it out there. And then if it does, you got to act quick because, there's a lot of hot air in this market. And same if you're short. We could have a blow off top here and could happen in a pretty quick, orderly fashion. So for right now, swing trade wise, keep it light, keep it diversified, spread your bets. And or if you don't know what you're doing, stay out of the market this week. Then you can re-engage next week when all this big market moving stuff like the Fed meeting and the election are out of the way. All right, guys, this has been Randy Finney with Right Side of the Chart. Have a great day.